Celsius expects big shelf space gains, possibly the best in its history, says Jim Cramer. Mad Money host Jim Cramer talks how energy drink stocks could rev up your portfolio. When was this? Friday, May 10th, 2024. Since then, Celsius stock is down 60%. Yes, he's done it again. Anyways, looking at Celsius right now, one share will cost you $31. It has a market cap of $7.23 billion, has a forward PE of 32.6 times, forward EV to EBITDA 22.9 times, price to sales of 4.7 times, and price to free cash flow, that's in the last 12 months, 29.4 times. And of course, all of those are lower than their 5-year mean. Now, of course, Celsius was growing extremely fast. I mean, this was basically a hyper-growth company. And now it is a growth company. It's not growing extremely slow, although some analysts expect it to only increase sales by 8.6% in fiscal year 2024 and EPS by just 9%. But then they're seeing some reacceleration in the next 2 fiscal years, growth above 20%. So yes, I would categorize it as still a growth stock. And yet, right now the stock has been obliterated. I've been talking about Celsius more and more because the stock is down and, well, the worse the sentiment, while the company is still doing well, I think the better the opportunity is. Of course, it might not interest everyone, energy drinks. I mean, let's face it, it's not the most interesting stock or company to invest in, but I mean, if there's money to be made, if you like the product, me personally, I like the taste of it, zero sugar as well. Yes, high on caffeine, so again, don't drink 10 of those things every day, just like don't drink 10 cups of coffees every day. But I think there's value to be found here. Again, I'll repeat it again and again. You don't have to buy this if you don't like it. Can it go lower? Yes. I mean, at $40, it was already extremely low compared to its high. But guess what? It went lower. We're now at $31. So let's go over a couple of things again. And I'll also show you a quick reverse DCF calculation in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Like, subscribe, do all of that. Always appreciate it. Trying to reach 60,000 subscribers by the end of the year. Hopefully we can reach that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, for those that missed this, Target named Jim Lee Chief Financial Officer. Now, Lee brings more than 25 years of experience in finance, strategy, team and culture leadership at PepsiCo. Most recently, as the company's Deputy Chief Financial Officer, he oversaw its global tax, treasury, investor relations, and environmental, social, and governance (ESG) basically reporting functions, and led the finance teams for Pepsi's international business, comprising approximately $35 billion in revenue. Prior to that, as Senior Vice President Finance of PepsiCo Beverages North America, he led financial planning and analysis and finance functions for brand and innovation, franchise bottlers, supply chain, and business development. Now, you know that one of the main reasons why Celsius stock is down a lot is because of Pepsi. Pepsi basically over-ordered last year from Celsius. Today, they are stuck with some inventory, so they're not placing big orders again with Celsius. And now, since there is this change from PepsiCo to Target, maybe it could affect Celsius because someone is going to replace this guy at Pepsi. Let's see how the relationship between Pepsi and Celsius continues. But to be honest, I think it will continue. I think it's a great relationship between both companies. Celsius is a fast-growing company as well. As you can see right here, it's the 3rd biggest energy drink in the United States. They launched in 6 extra countries in 2024. Celsius contributed 47% of all energy drink category growth year over year in Q2. Of course, there is some pressure in the category of energy drinks, but Celsius is still growing quite fast. And I've shown you also some screenshots of trending bestsellers on Amazon. Yes, they are doing some promotions right now to reduce inventory, but overall, in a struggling category, let's say, Celsius is still doing quite well. And it's not like this company is struggling to grow. No, revenue grew 23% year over year. North America grew 23%, internationally 30%, but of course internationally still only a small chunk of the overall revenue. But as they launch in more and more countries, I expect that to increase. Now, like I said in previous videos, just because you launch in new countries does not mean that it's going to be a successful launch. No, just some countries will not be attracted to these types of energy drinks and some others will. But overall, I expect that segment to grow year over year over year. Gross margin is up 320 basis points year over year. Net income up 55%. Diluted earnings per share up 65% year over year to now 28 cents. And adjusted EBITDA came in at $100.4 million. That's up 29% year over year. So yeah, when people say, oh, this is a struggling company. No, this is not a struggling company. This is a company that is growing, but it's not growing as fast as before. Now, what are the analysts expecting for the coming fiscal years, EPS and revenue-wise? So revenue, we've got up until here, December 2026, we've got 10 analysts with some projections there, like we've seen before. In 2024, only 8.7% year-over-year growth, followed by 20% and another 20% in 2026. And then only 2 are projecting for 2027, 28, and 29. So yeah, we don't really have that much to work with, but you can still see that it's growing quite nicely. Then some 2 years here of growing around 10% or so. With regards to EPS, growth is expected to be a bit better than that. So keep all of those numbers in mind when we're going to do that reverse DCF. Now, Celsius overall revenue in the last 3 years is up 517%. Free cash flow has been fluctuating a little bit. Gross profit margin is at 52% and has increased. Now, let's say they want to increase sales, right? Let's say there is some pressure, want to reduce inventory. What do? You lower price, you have some promotions, right? So yes, maybe gross profit margin will go down a little bit, but it's still quite high, 52%. So they've got some room to play with that. This is basically the issue. I've just shown you it is a growing business. But the issue here is that growth rates are coming down, right? We've seen that already happen in the past as well, although back here, growth rates were still 100%, 70% or so, despite it growing over 100% the year prior. But now we're entering a stage where, look, previously revenue was growing at around 111%, and now we're only growing 23%. But we're only growing 23% because we previously grew 100% or 90% or 70%. So yeah, it's not like the comparison, year-over-year comparisons are quite easy, but that's why you're buying Celsius, because this is a high growth company. So you cannot use both excuses, because I've seen some people use or try and use both excuses. Oh, it's growing, etc., etc. So you have to pay whatever you have to pay. No, you are paying a little bit extra because you expect it to grow faster, right? So yeah, we are now in a sort of, let's say, down cycle. But remember, when you have these lower growth rates, the year after that, especially because they are expanding internationally, it should be a little bit easier to beat those year-over-year comps. And as for free cash flow projections, in the last 12 months, that sits at $245.9 million. It's expected to be a bit lower by the end of this year, then growing a little bit by the end of next year, and then go back to growth mode in December or at the end of 2026. And so right now, if we look at Celsius, so the current price is at $31.02. Now I've put here, of course, the free cash flow trailing 12 months, as we've seen, $245 million. Terminal growth rate, I've put here 3%, meaning it is growing a little bit faster than your usual stock, which is what we are expecting, right? So 3% there, but still a discount rate of 10%. Of course, you can increase the terminal growth rate, you can put 4%, but then you might have to increase the discount rate to around 11, 12% or so. And so, what does it have to do to justify today's price? It has to grow free cash flow by 12.4% for the next 10 years. Does that seem like a lot to you? To me, it does not seem like a lot at all for this company, my expectations. Of course, this is purely opinion-based, because some people will say, even 12.4% is too much. To me, no. To me, this is not a lot at all. So if you want, you can play. If you want to play around, you can put here 15% if it's expected, or if you expect it to grow 15% for the next 10 years, then the stock is basically, well, undervalued. Should be up 17.6% or so. You can play around with that, of course, but yeah, I do think that with what we know right now and putting those numbers in, implied growth rate of 12.4% to me sounds like an opportunity. Of course, unless in the next coming quarters guidance keeps on being extremely bad, partnership with PepsiCo is not working out, etc., then of course things will change. But so far, really no indication of things being that bad. And so looking at the stock right now, we're a bit in no man's land under the 20-day moving average, which sits at $35. Yet there was previously some support here closer, well, a bit under $30 or so. Let's see if we go all the way back down or if we see support at around $31. But like I said, it's a bit in no man's land, so a lot of things can happen here. RSI is very, very close to being oversold on the weekly. Now the 50-day moving average sits much higher at $41 and the 200-day one at $55.3. So overall, to conclude with all the information that I provided to you, what do you think? Is it a buy? Is it a sell? Is it a to be seen? Let's see what happens in the coming quarters. Let me know down in the comment section below. Me personally, I think at $31, it seems quite attractive. So I will be adding a little bit to my position. Not by much, it's still a small position. I'm adding slowly but surely. Because let's be honest, if I did add quite a lot, I don't know, a month or two ago, well, I would be down quite a lot and that would hurt the performance of the portfolio. So slowly but surely does the trick here. That's all I've got for you right now. Let me know down in the comment section below if you agree, disagree, hit all the buttons, and I see you all in the next one. Bye bye.